What if I tell you there is a company that has been paying dividends for the past 30 years straight? Not only this, it has been able to increase those dividends in each of those years and hence earned itself the prestigious title of being called S&P 500 Dividend Aristocrat. It has been able to, over the past 20 years, deliver comparable results as the S&P 500. However, it also enjoys a beta of zero point 0.5 versus the S&P 500. Welcome to Realty Income, nicknamed the Monthly Dividend Company. Realty Income is the global leader in a fragmented net lease sector. It's the seventh largest global REIT with properties spread in 8 countries and nearly 58 billion in gross real estate value. It has a diversified real estate portfolio with 73% of their portfolio being invested in non-discretionary low price point or service oriented retail, 17% in non-retail and 10% in other sectors. It has an enterprise value of 83 billion and has a portfolio of 15,457 commercial real estate properties. Not only this, it enjoys an outstanding credit rating by Moody's and S&P of A3 and A-. Whenever I'm analyzing any stock, it is very important to understand the total market size in which the company is operating. In case of Realty Income, as it is a REIT, which is a real estate investment trust, the real estate market in US stands at $5.4 trillion, while that in Europe stands at 8.5 trillion. That's the market size of the aggregate net lease. Moreover, the number of competitors, which are the peers of Realty Income, in US there are 12, while in Europe it's only 2. So it has low competition while a huge runway for growth. Realty Income enjoys a track record of attractive total returns through consistent earnings and dividend growth. Its compound annual total return since 1994 NYSE listing is 14.1%, and it has also consistently increased its dividend by a rate of 4.3% compound annual dividend growth, again since 1994. So that's a track record of around 30 years. And that's why it's part of the S&P 500 dividend aristocrats. In addition to this, the stability and growth of its earnings enjoys a quite long track record, 29 years of positive total operational returns, and the median AFFO per share growth rate is 5.7. AFFO stands for adjusted funds from operation. That's the kind of in simple terms, it's the kind of a return that they are generating from their operations. For those investors who are risk averse and enjoy stability, Realty Income offers them stable earning and low dividend volatility. This is evident from the fact that Realty Income total share return downside volatility since 1994 listing on NYSE is 3.6%. This is the fifth lowest of all S&P 500 constituents. What does this mean for you as an investor in Realty Income? It means you can enjoy the dividends with a very low volatility and hence a very stable and predictable dividend returns over the years. For those investors who have a low appetite for risk or are generally risk averse, Realty Income offers them a very good opportunity. It has attractive risk reward versus the S&P 500 companies and its REIT peers. As you can see on the screen, the total return compound annual growth rate since 1994 for Realty Income is 14 with a beta of 0.5, while amongst its S&P 500 REIT peers, it offers one of the best opportunity in terms of both total returns and its beta. The lower the beta, the lower the risk, while the corresponding returns are quite on the higher side. So this is the best. This offers best of the both worlds for any investors who doesn't have too much appetite for risky investments. For any real estate investment trust, there are few operational parameters that are very important to consider, which are favorable occupancy, dividend growth, credit rating, and total return. As you can see on the screen, for Realty Income, in comparison to the S&P 500 REITs, it enjoys one of the highest credit rating, while number of years with negative growth rate stands at 0 versus the S&P 500 REITs average of 10.3%. Its dividend CAGR is one of the highest compared to its S&P 500 peers, while it has one of the lowest year-end portfolio occupancy of 96.6%, and the historical median has been 98.2%. This data is for approximately 30 years, so you can expect that it will do reasonably good in the coming years as well. Reality Income has been able to withstand the test of times. During the Great Recession of 2007 to 9, it has offered the lowest operational and financial volatility compared to the A-rated S&P 500 REITs. As you can see, its rental to revenue to EBITDA to the occupancy rate has all been one of the best among its peers. During the 2020 COVID pandemic, Realty Income has been able to deliver 3.1% dividend growth, while at the same time, its 2020 earning per share increased by 2.1%. It was one of the four retail net lease and one of the seven S&P 500 REITs and one of the four retail REITs with positive earning growth in 2020. So as you can see, in 2007 to 9 and in 2020 pandemic, both time it has been able to deliver outstanding results. The reason I very specifically highlighted these two slides is to give comfort to any investors that a company that has withstood the last two major crises will have the ability to withstand, God forbid, any upcoming global crisis and provide a secure and safe return to its shareholders. One of the reasons Realty Income has been able to deliver such consistent results even through the thick and thin of time is because of its strategy to diversify. As you can see, it has been able to diversify both into different industries and different property types, and it enjoys the tendency of some of the major players in the US and Europe markets. The top 20 clients of Realty Income falls into at least one such category which are resistant to changing consumer behavior. These industries are non-discretionary, low price point, service oriented and non-retail. So in addition to diversification, it is also very important for any real estate investor to enjoy a high occupancy rate for their investments in order to help them generate consistent returns. As you can see, Realty Income has been able to maintain a very high occupancy rate even during the various economic cycles. As you can see on the screen, in 2007 to 9 crisis, their occupancy rate dropped, but they have been able to still maintain it upwards of 96%. And post that, even during the COVID pandemic, they have been able to enjoy a very high occupancy rate. Another very important factor in any real estate investment, in addition to the occupancy rate and diversification, is the releasing activity. Realty Income has been able to release its investments at a rate of 104 to 105%. And in terms of its weighted average lease term, it's 9.4 years. So it means whenever it releases its properties, it will be able to generate a higher rental return compared to its existing returns. For Realty Income, its earning growth remains strong as size of its portfolio continues to increase. Its adjusted funds from operation per share growth is 5%, while its CAGR is also 5%. As you can see on the screen, over the years it has been able to deliver consistent results in terms of its AFFO per share CAGR, and its gross real estate book value has been increasing and now reached approximately $57 billion. Now, to sum up all this discussion, on your screen you can see the total return by period for Realty Income compared to the S&P 500 and the other real estate investment companies. As Realty Income in the trailing 12 months period offered a total return of 18.7% compared to the S&P 500 return of 38.16%. Over the medium term, that is 10 years, it offered 100% return compared to 249% for the S&P 500. While over 20 years period, Realty Income has been able to generate same amount of return as that of the S&P 500, which is 615% versus the S&P 500 return of 644%. This is a very remarkable achievement for a company that is specifically operating in real estate to match the same return of S&P 500 over a course of 20 years period. This behavior is very much aligned for the specific type of investors who are passive in nature and need consistent returns over a long term period, while at the same time they don't want to be left out of the remarkable returns that S&P 500 offers them. So over a long course of time, that is 15 to 20 years, you can see that any investment in Realty Income or which is a REIT would generate more or less the same returns that you will get from an S&P 500. At its current share price, the dividend yield for Realty Income stands at 5.5%. This is quite high return on as compared to the S&P 500 companies. And in the environment where we all know that the Fed has been constantly going to reduce its interest rates, the the chances of the Realty Income price going up is quite high, because this will be some of the options left on the market that offers a consistently very high dividend yield, while at the same time with being quite diversified and playing in an environment which is low beta rate of zero point 0.5 compared to the S&P. Therefore, in the coming days and months and years, we expect Realty Income to generate a good increase in terms of its price, as well as constantly keeps increasing its dividend to its shareholders while maintaining its dividend yield in the range of 4.5 to 6%. If you found this video insightful, please like and subscribe to encourage me to come up with more such videos in the future. All these videos are based on the companies that I have been personally evaluating for my own investments, and the objective is to share my own insights with you. However, please, before making any investments, always do your due diligence and make an informed decision. Thank you.